Hello and welcome back to this week's episode of Closed by Mo. My name is Mohammed. You can call me Mo. I'm hopefully your favorite YouTube host on most things real estate. I'm also a real estate investor and a broker based out of New York City. This week's episode, we're going to shift gears and focus something that's a little bit more relevant to commercial real estate. That is cost segregation. It's also tied into the 1031 exchange, and I made a video about that a couple of months ago as well, both on my YouTube and other social media platforms, which I encourage you to check out. All that information will be in the description section below, so just scroll down there. Without further ado, let's start talking a little bit more about exactly what cost segregation is and why it's useful for real estate investors, movers and shakers, and anyone interested in real estate. Now, in a nutshell, cost segregation is basically a mechanism set up by the IRS to front load a big chunk of your depreciation in the first couple of years of owning a property versus spreading it out over 30 years or if not longer for commercial properties, which if you're a real estate investor, it might start sounding like cash registers or the dollar symbols might be flowing out inside of your head. Basically, what cost segregation allows you to do is increase your cash flow by quite a lot, meaning let's say you buy a piece of property, you'd immediately be able to depreciate a certain percentage of that over 30 years or so every single year that you're filing your taxes. But if you're able to front load a lot of that depreciation in the first 5 years as opposed to almost 30 years, now you can reduce your taxable income burden by quite a lot more, meaning your overall cash flow for a specific property or a specific investment is going to increase, meaning your overall return on investment is also going to increase. Now, I want to say something here too. Cost segregation and 1031 exchanges, they're no form of tax evasion. This is a form of tax deferral. Meaning, if you were to buy a piece of property and you did like a cost segregation study on it and you were able to front load a lot of that depreciation over the first 5 years as opposed to 30 years, there is a mechanism called the depreciation recapture, meaning when it comes time to sell that property, the IRS is going to expect that amount of depreciation that you saved upfront back into its coffers, meaning Uncle Sam is still going to make some money off of you. They're still going to get their fair share of the taxes. It's in no way a means of tax evasion. However, the workaround here is that if you were going to be doing a cost segregation study on a particular piece of real estate, and then you 1031 exchange those funds into another property, meaning whatever proceeds you make from the sale, you are then allocating it to another bigger investment. Those taxes, whether it's capital gains taxes or even the depreciation recapture, you're effectively deferring them again up until there's another sale triggered, which you can hypothetically keep rinsing and repeating that process of 1031 exchanging and doing a cost segregation study to keep minimizing your overall debt burden or cost burden and increasing your NOI and cash flow. One thing you also have to understand is you can't just walk in and tell your CPA or accountant that you want to do a cost segregation study. You have to hire a cost segregation expert. So there are specialists, special accounting firms out there that you need to pay a nice chunk of change to for them to be able to do that. The way a cost segregation study works is they'll basically break down all the different assets inside your specific building overall. Let's say, for example, you own a big apartment building that has 50 units or so. You'd be able to, if you want to do like a straight line depreciation over 30 years or 35 or 39 years for commercial property, they just take the value of the property and then they divide it by that number of years. But if you did a cost segregation study and you hired a specialist, they'd be able to give you a breakdown of all the internal components of the property or the units themselves, whether it's like appliances, repairs, maintenance, things like that you can identify individually and then depreciate, and then they'd allow you to front load a lot of those line items in the first couple of years. Now, there are of course a couple of other costs that are associated with doing a cost segregation. You have to not just pay for the specialist, you also have to pay for the property inspection, make sure that that specialist is able to come out there multiple times to make sure that they're recording everything and identifying the components that can actually be reclassified for accelerated depreciation. You're also of course paying for the cost for that and the generation of that report itself, but that might actually be worth it for you if the overall cost of doing that will help you save a bunch of money up front from your taxable income, because you're able to front load a lot of that depreciation, right? So instead of you paying depreciation over 30 years, you're now paying it over the course of, you're now writing it off over the course of the first 5 years, 7 years, 10 years, whatever asset class or category of cost segregation that you're doing. If you're enjoying this type of video, do let me know in the comment section below. I'll see you guys next week. Bye-bye now.